I want to start with a thesis, and it's a fairly simple proposition. And the proposition is this: everybody watching this video is smarter than the best that Wall Street can produce. It may seem strange that I would suggest that ordinary investors can outperform the world's largest financial centre and all the associated horsepower they bring to bear to financial markets and problems. But as we go along, I'll assemble evidence as to why I think this is true and why I believe that with application, dedication and education, there is no reason why, I don't want to use the term average investor, but I will, the average investor cannot take control of their affairs and do far better than any advisory service, industry, or institution could do for them. To set the tone of this presentation, I want to start with this quote by the humorist Dave Barry. He says, Wall Street relies on stock analysts. These are people who do research on companies and then, no matter what they find, even if the company has burned to the ground, enthusiastically recommend that investors buy the stock. To some degree, this is the theme of what I will be talking about, but I'll also look at reasons as to why that occurs and why it occurs to the detriment of people receiving advice. I should also add the caveat that this is not limited to Wall Street. This occurs wherever there are financial advisors and stockbrokers and fund managers. So it is a universal problem. The question in part I want to ask is, where are the customers' yachts? And I actually stole this question from a book, which I'll recommend in a second. The book simply asks the question, if financial advisors were so good, why don't all their customers have yachts? Why do the brokers have yachts but not their customers? It's an extremely powerful question, and it was asked 6 decades ago by Fred Zweig in his book, Where Are the Customers' Yachts? Or A Good Hard Look at Wall Street. This is a book I recommend that everybody have in their library. The other book I recommend that everybody else have in their library is The Hedge Fund Mirage by Simon Lack. It looks at hedge funds. I understand that many who are outside of the industry think that there is some mystique to hedge funds, that they have some miraculous ability. It surprises many when they are told that the vast majority of hedge funds underperform, like the majority of funds, every index against which they compete. In the vast universe of hedge funds, and there are thousands, if not tens of thousands, very few outperform their index. Hedge funds generally seem to be set up as wealth transference devices. Wealth is transferred from the client to the hedge fund owners. This is why no hedge fund has ever made an individual investor a billionaire, but it has made their owners billionaires. It is a very sharp contradiction in what they should be doing. To begin the journey of looking at why these problems occur, why the advisory industry is so bad, I want to take a look at an historical event, and that is the collapse of Enron. It is my presumption, looking at the history of Enron, that Enron was never really set up as a real business. It was set up as a deliberate long con. And it's a long con that Wall Street fell for, hook, line and sinker. And as we'll see, even when it became apparent that it was a con, they continued to recommend it to their clients. So to do this, I've assembled this particular little graphic. Along the top we have a series of dates which are pertinent. Left-hand side, the names of a series of brokers and investment banks who were covering Enron, and along the bottom a series of prices, so you get a sense of where the price of Enron is heading as various events occur. I've then colour-coded the recommendations. The two to take note of are those in blue. Strong buy and buy. These are the things you need to be aware of. Although even having been in the industry, I never really understood the distinction between buy and strong buy, but that to a degree is an irrelevancy. So the first event to look at is when the Chief Operating Officer resigns having sold a basket of stocks. It should be noted at this time that there were rumours swirling around about Enron and its, let's say, lax corporate culture. We move into October and Enron reports a $638 million third quarter loss. Wall Street now implicates the executives in Enron in fraud, and shareholder equity shrinks dramatically. But notice, at no point when we've got to this point has there been a change in broker recommendations. In fact, Merrill Lynch went from hold to buy. We do get a change at AG Edwards moving forward, where they've moved from buy to hold. Once again, never understood what the distinction is. You're either a buyer of a stock or a seller. Holding it is an irrelevancy. Moving further into October, Wall Street Journal reports on the fact that there's now an SEC probe into Enron and its conduct. Arthur Andersen, in a remarkable display of corporate criminality, destroyed 1 ton of documentation relating to Enron. But again, we come back to our recommendations from brokers. The only change we see is that Bank of America, for a short period of time, suspended its recommendation. You can see, though, that it moved back into a hold. The rest are still holding where they were, particularly the group in the centre, which are the strong buy group. Nothing has dissuaded them from their opinion of the stock. Now, if you look along the bottom at the prices, we can see that Enron began this particular little journey at 43.60. At this point here, where Arthur Andersen has destroyed the documentation, it's 15.40. So it has had a precipitous collapse, but despite the precipitous collapse, it is still being recommended by Wall Street's best. Beginning of November, the SEC announces a formal investigation, and we do get 2 firms moving to strong sell. But you'll notice the stock is now passing through $11 towards $9. So the stock has lost $30, and it's only now that we're beginning to get a shift in advisor opinion. You would think the sheer notion that the stock had collapsed dramatically and had lost most of its value would be a prime driver of recommending that people sell this particular stock. You'll also notice that as we move forward, we have the strong sell from AG Edwards, we have the strong sell from Prudential. But the others maintain a hold. Dane Rasher eventually moves to sell. The others drop it from their advisory list when the stock is 36 cents. I think this is largely done as a let's all just forget about this and move on moment, where broking firms have tried to expunge the notion that they're actually involved in this particular stock. So let's have a little bit of a quiz and see if you are smarter than Wall Street's finest. We'll start with a simple test. This is I call the walk to the back of the room test. You put a chart up on the screen, you walk to the back of the room, you turn around, you look at it, and you will instantly know what the trend is. You require no great quantitative skill whatsoever. You simply need to look at the trend and go, well, is the trend up or is the trend down? And that will become immediately apparent, particularly when you have a strongly trending stock like this. However, we need to put this into context. That little table I presented begins when Enron was in the 40s. The collapse actually began from 95.90. So price had been falling for some time. You can ask yourself a second question, which I think you'll find very easy to answer. Is there more red than green on the screen? Are there more red candles? Red candles indicate a bearish tone. If the trend is comprised of red candles, then something has gone horribly wrong. Again, you don't require any great quantitative skill. You don't require banks of analysts to work this out. You just look at the chart and go, well, there's clearly more red than green. This thing's stuffed. Has price broken through support? This is the notion of simply drawing straight lines across a chart. A straight line is a remarkably powerful tool, and it's a remarkably powerful tool used by traders to generate signals to enter positions and or to leave them. Is price above or below its moving average? The rules again are simple. If price is above the moving average, we are a buyer. If price is below the moving average, we are a seller. We are never a buyer when price is below the moving average. That is telling you something. So all of these questions, simple that they are, means that if you answered them correctly, and there's no reason why you should not, means that you are smarter than every analyst who looked at Enron. This raises the question of why is the industry so bad? And there are a few reasons for this, I think. The first is they simply do not know how to trade, and that applies to every financial institution. In all my time in broking, I only ever met another person who knew how to trade, and they went out and managed $500 million on their own. No one else I ever met in the industry knew. They all knew how to sell, they all knew how to get people to take on positions, but if you asked them a question about position sizing or what would trigger you to exit a position, you would get a blank stare and they'd bugger off to the pub. There is ample evidence that institutions don't know how to trade, and this is global, this is a universal problem. It is not confined simply to the advice that stockbrokers or financial planners give. It's universal in nature. This is a snip I took of, for the past 3 years, the best performing superannuation funds in Australia. You have to remember superannuation is a vast industry here in Australia. You would think it would attract the best and the brightest. It doesn't. This is the performance they have generated in the past 3 years. This is a per annum return. And you think, 9.16% doesn't look too bad. The problem is the All Ordinaries Total Return Index for that time generated 9.75%. So you can see a clear degree of underperformance of their competing index. And this is the de facto standard for all funds around the world. It's a particular problem with Australian superannuation funds whose performance is universally poor, which is problematic because it will affect vast numbers of workers and the quality of their retirement. To give you a sense of how bad the advisory industry is, this is an historical study I took from looking at the Dow Jones. What it does is it looks at this notion of a cash to asset ratio. If you are very bearish, you advise your clients to move into cash. If you're very bullish, you put them into stocks. What this chart looks at is what happened to the Dow after a change in recommendation. So we have a series of dates. There is a wonderful collection of data in here. And what we see is I've marked those times in blue where the advisory industry got it right. They moved into the right asset at the right time. This is no better than a guess. Yes, it is historical, but things don't change. Nothing changes. And it's important to realise that. There is this assumption that as time goes on, that things change. In investing, they don't. Because the drivers and motivators of people giving advice don't change, and the drivers and motivators of people in markets and those who seek advice never changes. So there is no argument you can bring up that says, well, yes, this is 1956 to 1995. It's now 2024. I would find your argument invalid because market participants don't change. It's impossible for them to change. So in part we have a lack of talent, a lack of skill as a driver for why these individuals perform so badly. The other reason is a somewhat complex one, but I'll walk you through it. It is the notion of vested interest. To understand how the broader investing industry works, you'll find that, for example, an investment bank or a stockbroking house is split Let's say it effectively into two parts. There is a part that deals with corporate activity. These are things like listings, mergers, acquisitions. There is also a sales side or the broking side, which is the retail arm. In the middle are the analysts. When you look at the fees generated by stockbroking firms or investment banks, the vast majority of them come from their corporate activity. So how do you get corporate activity? Well, that's a sales job. Analysts will go out to various companies and flog their wares effectively. How do you stay in the good books of companies? Well, you simply don't generate an analyst report saying, company ABC is utter shit, sell all of it, because that would offend the people who run the company who might give you corporate activity. So there is a degree of vested interest in this. The more money that the corporate side makes, the more money that the sales side can make, because they have ideas and stock to pass on, particularly if it's an IPO, an initial listing. These are always very popular because there is this notion that you stag the listing and you make a fortune on the first day. Unfortunately, that hasn't happened for a very long time. But to give you a sense of the money involved in terms of looking at analysts, and this is not brokers per se, but remember I said the people who sit in the middle, these are the people who generate the scripts that are from the business generated by the corporate side. They generate a script for the stockbroking side. Stockbrokers operate to a script. They don't do original thinking. A stockbroker will very rarely be sitting there running some form of trading program looking for trading ideas. They will be reading what the analysts have said and then read that back to you, as if you couldn't read it yourself. You have to get a grasp of how much money is involved, and this is this notion of bonuses, making Wall Street's analysts the best paid in the world. So if you look at how this breaks down, you'll see that the average pay for an analyst in the US is a fair way north of $200,000 a year. This is US dollars. On top of that, there is a bonus, which is closing on $100,000 a year. The financial industry will never bite the hand that feeds it. What this means is that you will very rarely get sell recommendations. You will very rarely have an analyst pop up and say, this entire industry is stuffed, move on. For example, no industry when lithium collapsed here in Australia came out and said, look, lithium's a bust, it's all over, sell your stocks, let's move on, wait for the next opportunity. Because there is the off chance you might get associated business down the track that pays far more than someone putting through an order that generates $9 in brokerage. The other reason is the human brain is a bias engine. We see things through a perceptual filter. The finance industry sees things through the perceptual filter of buy everything. And it is very difficult for them to modulate that. To give you a sense of that, this is taken from a research paper done by Brad Barber et al. In 2006. And they trolled through some 438,000 recommendations from about 12,500 investing banks or broking firms. And they found that in 1996, 60% of recommendations were buy. 2002, that had crept up to 74%. In 1996, only 4% of all recommendations were a sell. In 2002, that had dropped to 2%, so that had halved. I then looked at this and went back and did a little bit of a back of the envelope one for the All Ordinaries. And I found that in terms of the ratio of buy to sell recommendations, in 1983, there were actually more sell recommendations than buy recommendations. There's a little bit of a problem here. The 1980s bull market began in 1983. This ratio had moved to 4 to 1 in 1990, 8 to 1 in 1995. Last time I did this, in 1998, it was 48.2 to 1. My perception is this has now moved to probably nearly close to 100 to 1. So we have this optimism bias that creeps in. And the optimism bias is problematic because it colours the judgment of the person giving you the advice. So you're only getting one side of the story. It's a little bit like, think of it, I've harped on about this before, when you've seen graphs of what happens to your return if you miss out on, say, the 20 best days over the past 10 years or the 10 best days over the past 20 years. It has a bias to it. And you can see the bias because it doesn't look at what happens to your return if you're not in the market for the 20 worst days or the 10 worst days. And as we've seen, the return is remarkably different. It means that you're not open to other opportunities that might arise. So we're caught with this, and this is from Brian Bruce from the Journal of Psychology and Financial Markets. He states that an investor might expect advice that is free of both psychological bias and self-interest. We've seen that's not true. Instead, they discover belatedly that the advice is a mixture of wishful thinking and self-serving hype, and that is certainly true. And whilst it seems overly cynical, let's step back a little bit and I'll ask a further question. When you come to invest, whose money are you investing? It's yours. Therefore, who should be the final arbiter of all decisions you make? And just for reference, this snip is taken from The Wolf of Wall Street, which could actually pass for a documentary on the financial industry. So what is my advice? My advice is simple. Learn how to do this yourself and do your own thinking. Once you take on board the responsibility of doing something, you also take on board the motivation of learning how to do it properly. You also take on board the responsibility of doing it properly. Responsibility is a good thing. You cannot outsource the blame then. Yes, I've known large numbers of people who do. Their excuse for getting it wrong is there's something wrong with the market's rigged, their PC's not quick enough, the chart's the wrong colour, whatever nonsense they come up with. But for those who persist and who persist with their education, you will do better than any financial advisor could ever advise you to do. And with luck, since we've just passed the anniversary of the crash that gets everybody's attention, you will end up far better than this individual.